Good morning, good afternoon, and good evening, friends. Let's continue with the account current, which is quite interesting, right? We saw in the last class. So, in the last class, we calculated the account current in the normal way by calculating interest. Now, the alternate method, what we saw is by means of products, right? What is what is by means of products means? Instead of calculating interest here, we calculated interest here. Instead of calculating interest on a daily basis, interest is calculated on the due date. On the due date. So the difference is like instead of taking the interest amount here, I'll just copy the same question here. Yeah. What we are going to do is in the products method, we're going to multiply the amount into the number of days. Amount into number of days. And on the both on the due as well as due to collect and due to pay. On both the sides, I'm multiplying this with the number of days, right? Now the interest has to be calculated for the balancing amount, which is equal to, let's say, the to interest account. Much more easier, much more simpler. And the transaction date is 1st February. 1st February. What is the amount due is 30,250. 30,250. And interest is for 1 day. Interest is for 1 day. This is equal to into 6 percentage divided by 365. So interest is 4 rupees 97 paise. 4 rupees 97 paise. So the interest calculated is the products. This is the products what sum of products what is coming on the basis the products what is being calculated, like 200 is the amount and 123 days due, what we saw in the last question. So the product is 24,600. Similarly, the product total net product coming into 30,250 and the interest is calculated for 1 day, that is from the date the statement is being made. Okay, so this is to again make it more simpler. Rather than calculating interest on a daily basis, the interest is calculated on the statement date. Other than this, the product method is similar to the initial interest method what we saw. Now let's give a brief on what is the other methods that we're talking about here. What are the other methods that we're talking about here is forward method and backward method. Yeah, let's get a brief about what is forward method and what is backward method. Let me put it here. Method of computing the number of days. Forward method. What is forward method is basically, under this method, number of days is calculated from the due date of the transactions to the date of the closing the account. So number of days is calculated based on due date and the date on date of closing the account. And what is the backward date? Backward method. It is also called as epoch method. Under this method, the number of days is calculated from the opening date of statement to the due date of the transaction. From the opening date to the due date of the transaction. Not due date of closing statement, but to the due date of transaction. In the forward method, number of days is calculated based on due date from the statement date, based on the due date to the closing date of the account. See, suppose we are preparing the statement on 2nd September and the closing date, like the amount is due say on 15th August. The number of days is calculated based, that is 15th August till 1st September. That is how the number of days is calculated. Whereas in the backward date, In the backward method, suppose the opening date of the transaction is 1st July and the due date of the transaction is say 25th August and the statement date is 1st September. The number of days is calculated from 1st July till 15th August. So in the forward method, number of days is calculated based on the due date and the date of closing the account. In the backward method, the number of days are calculated from the opening date of the statement to the due date of the transaction. Right. So let's try and solve a question based on this. Right. It's an example. Let me calculate the formula format here. Copy the format here. Example 3. Example 3. From the following particulars, make up the account current to be rendered by Mr. X to Mr. Y on 31st December 2016, taking interest into account at the rate of 18% per annum. So due date is, for transaction date is 1st July. Balance owing to Mr. Y, that is balance brought down. Balance brought down is equal to 600. And number of days in this method is we are preparing it till 31st December 2016, right? So is equal to July 31 days, August 31 days, September 30 days, October 31 days, November 30 days, and December 31 days. That's 184 days. This is due on 1st July because it's the opening date of the statement. Okay. So next transaction is goods sold to Mr. Y. Credit period allowed 1 month. To sales. To sales, it is sold on 30th July. Credit period allowed is 1 month, so it is due on 31st August. Amount is 300, and the number of days is equal to 30 days is equal to 30 days, 1 day in August, 30 days in September, 31 days in October, plus 30 days in November, plus 31 days in December. So 123 days. Again, it's based on the product, so we're just calculating the amount into number of days. Then the third transaction is goods purchased from Mr. Y, credit period received 1 month. Date of transaction is 1st August. 1st August, 2 purchases, and due credit period received is 1 month. Right, it is due on 1st September. Amount is 200. Number of days is equal to 30 days in September plus 31 days in October, 30 days in November, and 31 days in December. 122 days. It is due on 1st September. We should include the due date. Yes. Now next, cash received from Mr. Y. By cash received from Mr. Y on 1st September. Yeah, 1st September. 1st September, amount is 100. The due date is equal to the same days what we have here. Then what is the next transaction? Mr. Y accepted Mr. X draft at 3 months date. That is, it's bills receivable. 1st September by bills receivable. It is due on, all bills are due with 3 days grace period, right? So it is due on 1st October, 1st November, 1st December plus 3 days of grace period. So it is due on 4th December. 4th December, amount is 400. Number of days is going to be 27 days. 27 days. Now, what is the products coming in here? Oh, I think I made an error here. So due is on 1st September, right? Due is on 1st September. So we should now let's calculate the products. Interest to interest. This is 31st December. This is 31st December. Hope the students, you are clear so far, right? So in the calculations, if you see here, there is one error here. It is due date is 30th August. I made a mistake here. The transaction date is 30th July, and then its credit period is 1 month, so it's 30th August. And then while calculating the interest, we saw in the earlier class, like while calculating interest, due date should not be included, but the date on which the the date on which the closing is happening should be included. So here in this case, we should not include 1st September because that is the date on which the transaction falls due. So it's going to be 29 days in September. Just made this mistake. I'm rectifying it here. Okay, now what will happen is interest to be calculated. What is the amount on which interest to be calculated is equal to 147,300 minus 47,100. That is 100,200. Like 1,200,000 is on which the interest to be calculated at the rate of 18% for 1 day is equal to into 18% divided by 365. So the amount of interest due is 49 rupees and 41 pies. Right? The total amount is equal to, you have to take it here, other 49.41. That is the total amount due. How this is calculated is into 100, 200 into 18% divided by 365. That's 49 rupees 41 pies. Okay, the total amount due is equal to 949.41 minus 700, 249.41. Hope this is clear, right? Just in case you have any doubts or clarifications, and we'll continue into the forward method and backward method in the next class again. We'll go through another couple of problems and solutions. You have any doubts on this or clarifications required, please reach out to me at babupriya@redifmail.com. This is one of the most simplest chapters, and you have any doubts on it, please reach out to me. Thank you, friends, and have a great day.